As Benjamin Franklin once famously said, in this world, nothing is certain except death and taxes. Fortunately, there are plenty of ways to legally avoid taxes, and that's exactly what we will be exploring today. Now, I don't want you to get confused. Tax avoidance is completely legal and simply means taking advantage of any tax deductions, tax credits, or other tax reducing incentives made available through the tax system. Tax evasion, on the other hand, is the illegal act of deliberately hiding income or falsifying your financial situation in order to avoid or underpay taxes, and that is not what we will be covering in today's video. Now, for full disclosure, I am a licensed CPA, and the goal of this video is to help you keep as much of your hard-earned money in your hands, but be sure to perform your own diligence and or seek tailored professional tax advice based on your own specific situations. To start, there are two main legal ways to reduce your taxes: tax deductions and tax credits. Tax deductions reduce how much of your income is subject to taxes, while tax credits directly reduce the amount of tax you owe. In order to minimize the amount of taxes you owe legally, you need to take full advantage of both the tax deductions and tax credits available to you. Let's first begin with tax deductions. Number one, contributions to a traditional 401k. A traditional 401k plan is a company-sponsored retirement account where your contributions as an employee are deducted directly from your gross income. In other words, the money comes out of your paycheck before income taxes are deducted. As a result, your taxable income is reduced by the total amount of contributions you make throughout the year. The maximum contribution you could have made is $22,500 for the 2023 tax year and $23,000 for the upcoming 2024 tax year. If you are 50 years or older, you can make an additional catch-up contribution of $7,500 for both years. Number two, contributions to a traditional IRA. A traditional individual retirement account, like a traditional 401k, allows you and I to direct our pre-tax income toward investments that can grow tax deferred. The contribution limit for the 2023 tax year is $6,500 and $7,000 for the upcoming 2024 tax year. For people aged 50 and above, an additional $1,000 catch-up contribution can be made. Now, contributions to traditional IRAs are tax deductible in most cases, but not all. If you participate in an employer-sponsored program, such as a 401k or a pension program, and are a single filer, you would only be eligible to take the full deduction on contributions to your traditional IRA if your modified adjusted gross income was $73,000 or less for 2023 or $77,000 or less for 2024. Married taxpayers filing a joint return are subject to limits of $116,000 or less for 2023 and $123,000 or less for the upcoming 2024 tax year. Unfortunately, for single filers with a modified adjusted gross income of $83,000 or more in 2023 or $87,000 for 2024, and married filers with a modified adjusted gross income of $136,000 in 2023 and $143,000 for 2024, IRS does not allow you to take a tax deduction. The deduction is phased out if your income falls between the minimum and maximum levels, allowing you to take only a partial deduction. Keep in mind, IRA contributions must be made by the tax filing deadline, which for most taxpayers is on or around April 15th of each year. Number three, contributions to a health savings account. An HSA is a tax advantage medical savings account available to taxpayers in the US who are enrolled in a high deductible health plan. It's tax advantaged because your contributions reduce your taxable income and the money isn't taxed while it's in the account, even if it earns interest on investment returns. And as long as you use your HSA funds for qualified medical expenses, such as copays, prescriptions, dental care, and glasses, you won't owe taxes when you take money out of the account. The contribution limits for 2023 are $3,850 for self-only coverage and $7,750 for family coverage. For 2024, HSA contribution limits are $4,150 for self-only coverage and $8,300 for family coverage. In both years, those 55 years and older can contribute an additional $1,000 as a catch-up contribution. You have until the tax filing deadline to contribute to an HSA in order to be eligible for a tax deduction, which means for tax year 2023, you can make contributions up until April 15th, 2024. Now, as you may know, when filing your taxes, you can choose to either take the standard deduction or use Schedule A of the 1040 form to itemize your deductions. In general, you would only want to itemize your deductions if the sum amount of the individual deductions exceed the standard deduction you're given. For the 2023 tax year, the standard deduction for single filers is $13,850 and $27,700 for married couples filing jointly. For the upcoming 2024 tax year, the standard deduction will increase to $14,600 for single filers and $29,200 for married couples filing jointly. Now, while many people choose to take the standard deduction for its simplicity, it may actually be more beneficial for some individuals to take the itemized deductions. So let's go ahead and jump right into several of these itemized deductions. Number 1, capital losses. You have a capital loss if you sell a capital asset, such as stocks, crypto, or mutual funds for less than your adjusted basis, which is essentially just a fancier way of saying what you bought it for. So if your capital losses exceed your capital gains, the amount of the excess loss that you can claim to lower your income is the lesser of $3,000 or your total net loss. Now, if your net capital loss is more than this limit, you can carry the loss forward to future years. For example, let's say you have capital gains of $2,000 and capital losses totaling $6,000. This brings you to a net capital loss of $4,000. Since the amount of the capital losses you can claim in a year is $3,000, that is your deduction for this year, and then the remaining $1,000 would be carried forward to the next year. Number 2, charitable contributions. The maximum deduction for contributions to public charities is 60% of your adjusted gross income for cash contributions. Now, for non-cash contributions, the total deductions are capped at either 20, 30, or 50% of a taxpayer's adjusted gross income. Contributions must be made to qualified charities, which include religious organizations such as churches, federal, state, and local governments, nonprofit schools and hospitals, and war veteran groups. So unfortunately, those donations to a friend's GoFundMe page are typically not tax deductible. Also, keep in mind, any excess contributions can be carried forward for up to 5 years. Number 3, gains from the sale of your home. The tax code allows you to exclude gain when you sell your primary residence. To qualify for the maximum exclusion of gain, which is $250,000 or $500,000 if married filing jointly, you must have owned and used the home as your residence for at least 24 months over the last 5 years. The 24 months of residence can fall anywhere within the 5-year period, and it doesn't have to be a single block of time. Number 4, gambling losses. So gambling losses are deductible to the extent of your gambling winnings. For example, if you have $5,000 in winnings but $8,000 in losses, your deduction is limited to $5,000. You are not allowed to write off the remaining $3,000 or carry it forward to future years. Number 5, home mortgage interest. You can deduct home mortgage interest on the first $750,000 of mortgage debt if the mortgage originated after December 16th, 2017. If your mortgage originated prior to that date, then a higher limitation of $1 million applies. So let's say you got an $800,000 mortgage to buy a home back in 2016, and you paid $25,000 in interest on that loan during 2023. You can deduct all $25,000 of that mortgage interest on your 2023 tax return. However, if you got an $800,000 mortgage in 2023, your deduction would probably be a bit smaller. That's because the 2017 Tax Cuts and Jobs Act limited the deduction to interest on the first $750,000 of a mortgage. Number 6, medical and dental expenses. You may be able to deduct the medical and dental expenses you paid for yourself, your spouse, and your dependents during the taxable year to the extent those expenses exceed 7.5% of your adjusted gross income for the year. The deduction applies only to expenses not compensated by insurance. Qualified medical expenses must alleviate or prevent a physical or mental defect or illness. You can't deduct expenses that simply benefit general health, such as vitamins, or amounts paid for most cosmetic surgeries. So I'm sorry, Becky, but unfortunately, you cannot deduct your $15,000 facelift procedure. Now, as mentioned earlier, in addition to tax deductions, you can claim relevant tax credits in order to further reduce your amount of taxes owed. Let's discuss some of the most relevant credits available. Number 1, Earned Income Tax Credit. This credit helps low to moderate income workers and families get a tax break. It will get you between $600 and $7,430 in your 2023 tax year, depending on your filing status and how much you make. To qualify, you must have under $11,000 in investment income and earn less than $63,398 if you're married filing jointly. Number 2, Child Tax Credit. If you have a child, you may be eligible for the Child Tax Credit. For 2023, the credit is up to $2,000 per child, and to qualify, a child must 1, have a social security number, 2, be under age 17 at the end of the tax year, and 3, be claimed as your dependent on your tax return. Keep in mind that the credit starts to be phased out once your income exceeds $200,000 for single filers or $400,000 if filing a joint return. Number 3, education tax credits. There are 2 possible education credits available to you: the American Opportunity Tax Credit and the Lifetime Learning Credit. The American Opportunity Tax Credit is for qualified education expenses paid for an eligible student for the first 4 years of higher education. You can get a maximum annual credit of $2,500 per eligible student. To qualify, the student must be enrolled at least half-time and can't have any felony drug convictions. The Lifetime Learning Credit is for qualified tuition and related expenses paid for students enrolled in an eligible educational institution. The amount of the credit is 20% of the first $10,000 of qualified education expenses, or a maximum of $2,000 per return. You can claim both the American Opportunity Credit and the Lifetime Learning Credit on the same tax return, but you can't claim both for the same student. Number 4, Retirement Savings Contributions Credit. Depending on your adjusted gross income, the amount of the credit is 50, 20, or 10% of up to $2,000 for a single filer, or $4,000 if married filing jointly, in contributions you make to a 401k, IRA, 403b, or certain other retirement plans, making the maximum credit $1,000 if a single filer, or $2,000 if married filing jointly. For example, if you are a single filer and contributed $2,000 to your IRA and your adjusted gross income shown on your tax return is $22,000, you would be able to claim a 20% credit of $400 for your $2,000 IRA contribution for your 2023 tax return. Number 5, Clean Vehicle Tax Credit. If you bought a new plug-in electric vehicle or fuel cell vehicle in 2023, you may qualify for a credit up to $7,500 under Internal Revenue Code Section 30D. The $7,500 credit is made up of battery and sourcing requirements, each adding up to half of the credit. If the car meets both requirements, it is eligible for the full credit, and if it only meets one requirement, it may be eligible for a partial credit. There you have it, guys. I hope you can all take advantage of many of these tax deductions and credits available to lower your taxes as much as possible. If you found this video helpful, be sure to check out these other 2 videos in this series. As always, thank you all for watching, and I hope to see you in the next one.